Okay, let's unpack this. Imagine two colossi standing at the crossroads of your financial future, the enduring institution of stocks and the disruptive, often bewildering world of cryptocurrencies. They both promise growth, right? But their foundations, their rules, their very souls couldn't be more different. Perhaps you felt the pull of one or, been intrigued by the hype around the other. Or maybe you're simply trying to make sense of the constant chatter about market crashes and overnight millionaires. Either way, you're looking for clarity in a very noisy landscape. Our mission today is to cut through that noise. We're going to give you a clear, data backed comparison and help you understand which of these paths, if any, genuinely aligns with your financial journey. Think of this as your shortcut to being well informed without getting bogged down in jargon or conflicting advice.
What's truly fascinating here is how these two asset classes, despite both aiming for financial appreciation, represent fundamentally different philosophies of value and risk. One is a product of centuries of established financial architecture, steeped in tradition, you could say, while the other is a digital experiment, really pushing the boundaries of what money and ownership even mean. We're not just defining them. We're exploring the implications of their differences and why those differences matter deeply to your portfolio choices. Our goal is to provide a practical, evidence-based guide to promote truly informed, responsible investment.
Okay, let's begin with the bedrock of modern investment stocks. You probably know that buying a stock means owning a small piece of a company. But the real insight isn't just what it is, but what that ownership entails, right?
Exactly. It means you're investing in a real business with tangible assets, products, services, and, a workforce. This ownership gives you proportional rights like receiving potential dividends from company profits, or maybe even a say in major decisions, depending on the share type. What's crucial is that these shares aren't just floating in the ether. They're traded on highly regulated exchanges, like the New York Stock Exchange or NASDAQ, even Europe's CNMV. This structure is key.
Right. The existence of these regulated exchanges means there's a standardized, transparent process for buying and selling.
Precisely. And it also means these companies are subject to rigorous oversight by governmental bodies like the SEC in the U.S. This regulatory framework means companies have to adhere to strict accounting standards, disclose their financials publicly, and operate within established legal boundaries. For you, the investor, this translates to a layer of protection and a greater ability to, analyze what you're actually buying.
Okay, so that makes sense. More predictability, perhaps.
Generally, yes. This leads to more predictable performance over the long term. For instance, studies like one from the University of New York last year show the U.S. stock market, post-inflation, averages a very respectable 7–10% annual return over decades. It's a system designed for stability and, measured growth, where fundamental analysis, looking at a company's earnings, debt, future prospects, is paramount.
Okay. Now, if stocks represent this established regulated order, then how do cryptocurrencies with their entirely different DNA disrupt that? And I mean, why have they commanded so much attention?
Cryptocurrencies are indeed a radical departure. At their core, they are digital assets that operate on decentralized networks, fundamentally built on blockchain technology. Think of blockchain as a kind of public, tamper-proof digital ledger maintained by a global network of computers rather than a single bank or government.
Right, no central authority.
Exactly. Bitcoin, created by the anonymous Satoshi Nakamoto back in 2009, was the pioneer, proving that a purely digital peer-to-peer cash system could exist without that central control. Since then, thousands of others have emerged: Ethereum, Ripple, Cardano, just to name a few very well-known ones. What truly defines them is this decentralization. No central bank, no government controls them directly. Their value isn't backed by a physical asset or a national economy. It's derived from supply, demand, their utility within their network, and importantly, the collective trust users place in their underlying technology and community.
That decentralization, it sounds like a double-edged sword, doesn't it? I mean, freedom from traditional financial gatekeepers, that's a huge appeal for many. But it also means they're often more vulnerable to pure speculation and rapid shifts in market sentiment rather than clear company fundamentals.
That's a very good way to put it. And when we talk about shifts, we're talking about extreme volatility sometimes.
Hmm.
Bitcoin, for example, famously surged to nearly $69,000 in November 2021, only to tumble down to around $16,000 by 2022. Those aren't just fluctuations. That's a roller coaster that can be frankly dizzying for investors.
Yeah, I can imagine.
Indeed. And much of that volatility stems from their still developing regulatory landscape. While traditional markets have decades, even centuries of legal frameworks, Crypto regulation is often limited, fragmented, or even non-existent in many places. This creates significant legal and security risks.
Although, are things changing there? I hear talk about new rules.
Yes, it's worth noting that some regions are actively building frameworks, like the EU's MiCA regulation, approved in 2023, which is a significant step towards bringing some order. But it's still a slow, global patchwork process.
Okay. And this leads to the performance question, I guess. The headlines are often about massive gains.
Right. The potential for spectacular returns in the short term is what often grabs headlines, but it comes with seriously amplified risks. The University of Cambridge, in a 2022 study, revealed a pretty stark truth. A staggering 60% of cryptocurrencies launched before 2018 have in fact lost all their value.
60%, that's a
Okay.
lot.
It is. And this isn't just about price dips. It's often due to project abandonment, flawed economic models, so-called tokenomics, or even outright rug pulls, where developers just disappear with investor funds. But beyond pure investment, though, it's fair to say many cryptocurrencies offer other uses, things like enabling smart contracts. These self-executing agreements coded directly onto the blockchain, as you see with Ethereum, or powering decentralized applications, or dApps.
Okay, so this is where it gets really interesting, laying out the key differences side by side. This is where you'll see just how distinct these two investment paths are, not just in theory, but in their practical implications for, your money.
Absolutely. First, let's consider their very nature. Stocks mean ownership in a tangible company, with real assets and a business model aimed at generating profits. Pretty
Oh,
straightforward.
right, something concrete.
Whereas cryptocurrencies are digital assets based on distributed ledger technology, without that direct physical backing. Their value often hinges on network effect, utility within a decentralized ecosystem, or sometimes just community consensus and belief.
That distinction immediately impacts regulation, as you mentioned. Stocks are highly regulated.
Yes, by established government bodies, providing a robust layer of investor protection and mandating transparency. We know the rules, more or less.
And crypto.
For cryptocurrencies, that oversight is still evolving, as we said. While initiatives like MiCA are emerging, the global landscape remains largely unregulated or inconsistently regulated, exposing investors to greater legal and security risks.
Which brings us back to volatility again. Stocks move, sure, but crypto seems different.
It is. Stocks exhibit moderate volatility, typically driven by business fundamentals, economic shifts, or company-specific news, things you can often trace back to real-world events. Crypto, conversely, is characterized by extreme, often unpredictable volatility.
Huh?
Remember that University of Chicago study from 2021? It found 51% of Bitcoin's trading volume was driven by unregulated speculation.
Half of it. Just betting on the price, essentially.
Pretty much, highlighting how much of its price action can be detached from traditional economic indicators or intrinsic value in the traditional sense.
Okay, performance then. Stocks seem steady long-term.
Exactly. Stocks have a proven track record of stable long-term growth, averaging that 7–10% annually after inflation, based on historical data like Dan Madaren's research. Predictable, relatively speaking.
And crypto, the moonshot potential.
Cryptocurrencies offer the potential for extraordinarily high returns, yes, and it's but they carry a proportionally higher risk of significant, even total loss. The Cambridge study on failed projects really underscores that.
Accessibility seems different too. Getting into stocks feels more formal.
Generally, yes. To buy stocks, you'll typically need a formal brokerage account, a more structured entry point with identity checks and so on. Cryptocurrencies, on the other hand, are often easily accessible through digital exchanges like Binance or Coinbase.
Which can make them seem deceptively simple.
Potentially, yes.
Yeah.
Easy to acquire, maybe without fully understanding the underlying complexities of digital security like managing private keys, those crucial cryptographic codes that actually prove your ownership. Lose them, and you lose your crypto.
Okay, and transparency. Stocks have reports.
Right. Publicly traded companies provide regularly audited financial reports, offering clear insight into their health, their debts, their revenues. With cryptocurrencies, while the blockchain itself is transparent about transactions, you can often see the flow of coins. The financial health or operational stability of the project behind the coin can be far less transparent. It often depends heavily on the developer community's openness and honesty.
Right, makes sense. Finally, the time horizon. Stocks for the long game.
Generally, yes. Stocks are usually better suited for long-term investments, held for years or decades to benefit from compounding growth and ride out those inevitable short-term market fluctuations. Cryptocurrencies, due to their speculative nature and rapid price swings, are often viewed as more appropriate for shorter-term trading strategies. Though some investors do hold them for the long haul, banking on transformative, albeit highly uncertain, future growth.
Wow. Okay, this comparison really highlights that the right choice isn't about one being inherently good or bad, is it? It's about how well it aligns with your personal circumstances.
Exactly. And this raises an important question for you, the listener. How do you determine which of these assets is truly suitable for your financial journey? It really boils down to a few key personal factors.
Like risk tolerance.
Absolutely paramount. If you're someone with a low risk tolerance, prioritizing capital preservation and steady growth, then traditional stocks, especially well-established blue-chip companies, are generally more suitable. They're backed by real assets and ideally consistent earnings.
And if you're okay with more risk,
Well, if you have a high risk tolerance and you're genuinely willing to accept the possibility of significant losses for the chance of those outsized returns, then cryptocurrencies might appeal to that part of your investment profile. But you have to be honest with yourself about that tolerance.
and your financial goals must play a huge role too.
Definitely. Are you aiming for long-term growth for retirement or maybe a child's education fund? Then stocks, particularly diversified options like index funds or ETFs, which spread your risk across many companies, are typically ideal. They smooth out the ride. But if you're maybe pursuing quicker gains, perhaps for a shorter-term goal, cryptocurrencies offer that potential, though always with that elevated risk of significant drawdowns.
Knowledge and experience must factor in too. Starting out can be daunting.
Critical considerations, yes. For beginners, stocks often provide a more secure entry point. Why? Because of the abundance of established analysis tools, historical data, and readily available regulated information. Cryptocurrencies, however, demand a steeper learning curve. You really need additional technical knowledge about blockchain, how digital wallets function, and frankly, advanced digital security practices. That can be challenging, especially for non-technical users.
Absolutely. And, it's not always an either decision, is it?
Not at all. Many savvy investors adopt a diversification strategy, combining both. For instance, an approach might be allocating, say, 80% to stocks for stability and long-term growth, and maybe 20% to cryptocurrencies to capture some of that high growth potential, while carefully managing overall portfolio risk. It's about creating a balance that truly suits your unique profile and objectives. There's no magic formula.
So, okay, beyond these definitions and comparisons, what does the hard evidence from academics and researchers actually tell us about these two paths? It's always valuable to look past the headlines and dig into the data.
Well, when we examine stocks, research like that work by Aswath Damodaran at NYU we mentioned consistently shows that broad market indices like the S&P 500 have outperformed many other asset classes over the long haul. We're talking an average of 7% annual return adjusted for inflation since way back in 1928. That's a powerful track record of consistent wealth generation, really rooted in overall economic growth.
That's compelling. But what about the crypto side from researchers?
What's insightful there is that while the alluring stories of rapid crypto gains are tempting, these studies really underscore the foundational differences in stability and regulatory oversight. That University of Cambridge analysis from 2022, while it acknowledged those spectacular returns in certain crypto periods, emphatically cautioned that they are unsuitable for conservative investors. Why? Because of extreme volatility and the lack of robust regulation. It really brings into focus the different psychological profiles these assets tend to attract or perhaps should attract.
Right. And you mentioned the University of Chicago finding, too, about speculation.
Yes, that finding that 51% of Bitcoin's trading volume is driven by unregulated speculation, rather than, say, its use as a payment system or its fundamental value, that's a significant insight. It illustrates that much of the crypto market's movement, at least historically, has been about betting on price swings, not necessarily investing in a company's long-term success, like with stocks.
That's a critical insight. And it leads us directly into some very real challenges that investors, particularly in the crypto space, need to be acutely aware of.
Definitely. One of the most pervasive challenges is simply financial literacy, or maybe technical literacy in this case. Many investors, especially those drawn perhaps by the hype to the fast-moving crypto market, lack sufficient technical knowledge. They might not fully understand the underlying blockchain mechanics, how to properly secure their digital assets, or the myriad factors that truly drive value beyond just sentiment.
Which increases their risk.
Significantly, it elevates their risk of loss, not just from market fluctuations, but from security vulnerabilities getting hacked, or simply making uninformed decisions based on emotion or social media buzz rather than solid research.
And the regulation piece keeps coming up, that patchwork situation.
Indeed. The regulation of cryptocurrencies continues to be, well, a global puzzle. The absence of a clear, unified global framework creates immense uncertainty and legal risks. While we see regions like the EU making strides with MiCA, the fragmented nature means that what's permissible and secure in one country might be entirely different or even illegal in another. It makes navigating the space incredibly complex and poses significant risks for average investors.
Then there's just the sheer market volatility we talked about.
Right. While both markets have their ups and downs, crypto's unpredictability can be dizzying. It really tests the emotional resilience of even experienced investors. And linked closely to that is digital security.
The wallets and keys.
Exactly. Cryptocurrencies demand advanced security measures, understanding various wallet types, hot wallets, cold wallets, diligently managing those crucial private keys, recognizing sophisticated phishing attempts. These are often complex concepts for non-technical users, making them vulnerable to hacks or just accidental loss of access to their own funds.
And finally, a huge issue today everywhere, but maybe worse in crypto: misinformation.
A pervasive challenge, absolutely, amplified in the fast-paced, often tribal crypto world. The rapid spread of unverified information, often fueled by influencers on platforms like X or TikTok, can lead to impulsive investment decisions based purely on hype or FOMO, fear of missing out. It's really a minefield for the unwary, underscoring the absolute need for critical thinking and validating your sources of information.
Wow, okay. We've really done a deep dive into two incredibly dynamic and, yeah, at times perplexing investment avenues. The key takeaway here for you listening is hopefully clarity. Understanding these fundamental differences isn't just academic, it's the first essential step towards making informed choices that truly serve your financial future. To summarize, then, stocks offer stability, establish long-term growth potential, and operate within a highly regulated, transparent environment. That makes them generally suitable for traditional investment goals. Cryptocurrencies, on the other hand, offer the promise of high, potentially rapid returns, but demand a significantly higher tolerance for extreme volatility and risk, often with less regulatory oversight and, crucially, greater personal responsibility for security. It truly is about your personal financial goals, your comfort level with risk, and your commitment to continuous learning and due diligence. This is far from a one-size-fits-all situation, and understanding your own profile is probably your greatest asset here.
Ultimately, knowledge is most valuable when it's understood and applied correctly. The decision between stocks and cryptocurrencies, or how to blend them, must be rooted in a careful assessment of your objectives, your time horizon, and your disposition to risk. And this raises an important question for you to consider. In a world of increasing financial complexity and these rapidly evolving digital assets, how actively are you validating your sources? How rigorously are you seeking professional, unbiased advice before making a move? And perhaps consider this: given the rapidly evolving landscape of digital assets, will the regulatory frameworks for cryptocurrencies ever truly catch up to provide the kind of stability and investor protection that traditional markets offer? Or is their inherent decentralized nature destined to always maintain a higher level of intrinsic risk, appealing perhaps to a different breed of investor entirely? Consulting reliable sources and, where appropriate, professional financial advisors is not just recommended. In this environment, is pretty much essential for navigating this brave new world responsibly.
Absolutely. Couldn't agree more. Stay curious, stay informed, and invest wisely. That's all for this deep dive. Until next time.